Shares of Enphase Energy have been through an absolute roller coaster. As I'm recording, shares are down 61% from their all-time high. We're down as much as 80% late in 2023. That was when things got really bad in the solar industry. Now we're seeing some signs of recovery, but I wanted to go through the recent financials that we got, put some context into where we are in solar right now, and whether there is a recovery or not, whether this is a good buy, because this is still, I think, a pretty expensive stock. The question is, and the question has always been for Enphase, is it worth paying the price that shares are trading at? So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's just take a look back at revenue and net income for Enphase over the last couple of years. This is a look at Enphase's revenue in orange and net income in blue. One of the things that always surprises me when I look at Enphase is, for all of the bad news over the past couple of years, Enphase is still profitable. Last quarter, they sunk to a little bit of a loss, but if you look at the trailing 12 months, still a very solidly profitable company. I'm going to pull this quarterly number as well. This shows how quickly revenue has dropped. And this is not something that is just Enphase where this has happened. This has happened for SolarEdge, which would be their biggest competitor. But you can see that revenue peaked at $726 million, now $263.3 million in the most recent quarter. So just a massive drop off in demand. But what the company has done really well is adjust their cost structure so that they have remained profitable on a trailing 12-month basis and just barely losing money on a quarterly basis. So a really solid cost structure should give you even more operating leverage as the business does recover, which they continue to expect is going to happen more in 2024 and towards the second half of the year. But I wanted to cover one thing about why revenue growth was so strong as it was and why revenue dropped as quickly as it did. And that's inventory. And this is something that doesn't get a lot of attention from investors, but it's really important to understand because Enphase doesn't end up selling its product to end customers. It sells to installers or to distributors. So both of those sets of people are going to have inventory. If you go to an installation and you don't have your Enphase inverters, that's going to be a huge problem for you. So you're going to want to have some Enphase inverters in inventory. That means that you need to make orders for Enphase inverters before you actually install them. That's called filling the channel. So as module level power electronics rose to prominence in the solar industry, in the residential solar industry, there was a lot of filling the channel for Enphase and for all the other players in the solar industry. That led to a ton of growth. Yes, there was end market demand growth as well, but there was also filling that channel. What happens when demand goes down is those installers say, you know what, instead of doing 10 installations a month, I'm only doing 5 installations a month. I'm going to take that inventory that I used to have, and I'm not only going to cut it in half, I'm going to probably even try to save some money by cutting it by 60, 70, 80%. So that's what we've seen over the past year. That's why revenue has dropped as quickly as it has. Management talks about this on every call, and really this has happened across the industry, is they've gone, you know what, demand is down from end customers, but it's down even more for these suppliers into the market because sell-through, selling to end customers, is higher than sell into the channel, which is the sales that Enphase sees. And so their revenue decline is going to overshoot. So revenue overshoots on the growth side and also overshoots on the downside. That's exactly what we've seen recently. The question really is there opportunity for the company and for investors going forward? If the industry does start to recover in the second half of this year into 2025, this could be another compelling company and a compelling stock because this was one of the major winners over the last few years in solar. But this is where you get to the price, and this is the challenge that I have with Enphase Energy. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. It's a little bit hard to judge Enphase Energy based on a price to earnings multiple given the volatility of earnings, the E part in that ratio, over the past few months. Like I said, last quarter lost money. They were very profitable a year ago. So I don't think that's the best judge of how you're going to look at valuations for the stock. But one way to look at valuation is the price to sales multiple. That's the orange line that you see here. The price to sales multiple has peaked at nearly 27 in 2021, has consistently been above 15, and right now is 9.1. So revenue is declining. Those trailing 12-month numbers are going to actually look even worse as we go throughout the year. So the price to sales multiple is probably a little bit higher if you just annualize the last quarter or 2 quarters. But you can see that this is in no way a cheap stock. You can find software companies that are continuing to grow and grow consistently, have very, very high margins that are trading for a lower price to sales multiple than this. And this is a hardware company, remember. The other line that I put on this chart is operating margins. And these are quarterly numbers, but their operating margin was in excess of 20%. And one of the things that investors really liked was the increase in operating margins each quarter, but that has dropped off a map over the last couple of quarters. That shouldn't be all that shocking. What I really question with Enphase and for a lot of these component suppliers is how much are these margins going to go back up? Because at the end of the day, the people who are making decisions about what components are being purchased, what they're going to be willing to pay for those components, are the installation companies. Those companies are still really struggling to get to gross profit and positive economics generally. So this is SunPower, Sunrun, and Sunnova would be kind of the big 3 players in the US. There's a lot of other players internationally. But as interest rates have gone up, it's made their business much more challenging. One of the things that's been interesting to watch with those installers is that they are expecting the cost of components to start to come down. So as their finance costs go up, they have to take costs out of the system somehow. How are they going to do that? Well, one thing is to put pressure on your component suppliers. So that might be your inverter suppliers, might be your battery suppliers, it might be your solar panel suppliers. We know that panel prices have started to come down, but I think we're going to see much more price pressure on Enphase Energy and some of these other component suppliers in the future than we've ever seen in the past. And that's going to mean that the operating margins and gross margins that Enphase is going to be able to generate isn't probably going to be as high as it once was. We have heard a lot of discussion about more competition coming into the industry that hasn't really materialized in the space that Enphase sits, kind of the brains of the solar ecosystem. But that doesn't mean that it can't, and it doesn't mean that it won't actually make its way as some of these Chinese suppliers in particular start to improve their products. So that's really the question that I have. And that's the reason that the price to sales multiple to me is just too high for Enphase Energy. If we had a price to sales multiple that was more like 2 times, 3 times, not 9 or 10 times, that would be much more compelling. And this is where you see that the value just isn't there with this stock. Still a market cap of nearly $17 billion as I'm recording today. That is an incredibly high valuation for a company that might be facing margin pressure in the future. So as a result, I don't think Enphase is a good buy today. I think a lot of the recovery in the stock is assuming that conditions are going to return to what we had either prior to the pandemic or during the pandemic when there was a lot of demand for solar installations. But we're not going to have low interest rates like we had in that environment. We're not going to have installers installing as much as they possibly can. We're going to have much more scrutiny on what component costs are going to look like. And that goes up and down the list of components that installers use. So that's my real hesitant with Enphase Energy right now. If the company was trading for a different valuation, I'd be much more compelled. But we're not there at this point. But what do you think about Enphase Energy? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.